Hey everybody, it's Matt. It is Friday, May 5th, Cinco de Mayo. It's just about to be 5 p.m. here in Houston, and so as per tradition, I'm sending an ill-timed video to all clients talking about investment stuff for you to enjoy over the weekend, especially if you're having trouble going to sleep. Um, so I do my office hours once a month. If you're not familiar, the first Thursday of every month, my Zoom meeting room is just open for an hour at noon Houston time. And anyone who would like to is welcome to jump in. You don't have to set an appointment. Just come join. If you have a question, a quick thing you want to talk about, um, it's office hours. Just come chat about it. Be aware that it is publicly open to my clients. And so, if you join, there may be other clients there. So if you prefer anonymity, then, you know, set up a meeting, call me, text me, email me, whatever. We can set up a meeting to talk privately. Obviously, I'm not going to share anybody's financial information while other people are on the call with us. But if you just have general questions, like in this case, the question I got in office hours was, how do I think about alternative investments, and what is sort of the CFA academic view on how much somebody should allocate to alternative investments. So that was the second time I've been asked a question recently. I've had two clients come asking about this, and so I figure if two of y'all are asking, then more of y'all might be interested, so that's what the video is about today. So you'll see up here there's the title, and then you see up here, this is not a mistake. I am pro alternatives. I put that there, and it's gonna stay there for the entirety of the presentation, because I want everyone to understand that at the end of the day, I like alternative investments. I am pro alternative investments. My family has alternative investments in our overall portfolio. And I'm going to leave that there because two things. One, by the nature of my business, I can be biased against you taking money away from stocks and bonds that I manage for a fee and going and buying real estate or art or collectibles or investing in some, like a friend's company that just got started. So there's just this natural bias in terms of how I can be paid, that says that I might be, trying to talk people out of doing alternative investments. So I want to be clear that, I believe that I manage that bias well. And then the second thing is, this presentation is going to give you a lot of reasons to be wary of alternative investments. So that's why I'm leaving this here. I am pro alternatives. I just want you to have a better understanding of what they are, how they work, why they're good, what the risks are, all that sort of stuff. And there's going to be sort of a heavy emphasis and maybe a little bit of kind of irreverence in my tone of voice, because as you'll see, I've actually sold these before to financial advisors in my prior career, and I know how they work, and I know the pros and cons of them. So first, okay, what are they? So this can be super annoying. Alternatives are anything that is not a stock or bond. And within that universe, it's really anything that is not long only stocks and bonds. Long only is jargon for, how else to say it, for positive investments in stocks and bonds. So you may be aware that if you think a company is going to do poorly, you could bet against that company. Or if you think a bond is going to do poorly, you could bet against that bond. You could do what's calling short. You could short a stock, or you could short a bond, or you could short a lot of things. So that would actually be considered alternative also, to bet against stocks and bonds. So really, I think the way to say this without the jargon is anything that is not a positive bet for, or a positive investment in stocks or bonds. So as you can imagine, the universe is enormous. Some examples of what alternative investments may be: real estate, private equity, private credit, commodities, collectibles, art, other things. I'll briefly say crypto. I do not. Anyway, crypto could be there. And I coded this purposely to look like a spectrum or a rainbow, because this is a huge spectrum of things. Like, many of these are not like the others. Real estate is not like art. Collectibles are not like private credit. It is a giant catch-all bucket And I think it really does a disservice because people like me will get asked about what do I think about alternatives. Well, like the spectrum is so enormous, there's no way to give a concise answer about what I think about alternatives. Each category in and of itself is huge. Some examples: real estate. I have clients that own Airbnb properties. I have clients that own an office building. There's people that own apartment buildings. For private equity, that might be like investing in your friend's company or something like that. Private credit, you could go buy bank loans. You could go to a bank and buy their loan portfolio at a discount if they're in trouble and need to sell it. Commodities, there's precious metals, there are industrial metals, there's food, there's oil. I love guitars. I've got a lot of guitars that I would love to think are collectibles that might be worth more than I purchased them for 50 years from now. Probably not, but that would be great if they were. Art. You hear about ultra wealthy people buying works of art for tens of millions of dollars, hundreds of millions of dollars, and crypto, like I mentioned earlier, right? So this is just there's this huge array. And I think that brings me to a little bit of a pause, where I just kind of want to point out, I'm going to point out two things. One is I wrote a blog. This says it's updated May 24th of 2021. I think I wrote this in 2019. Maybe I updated it since then, back in 21. But it's my investment philosophy without the academics. And I talk about this. I talk about, I go through my philosophy, but then I talk about the academics, but I'm trying to use logic as opposed to formulas. And I talk about stocks. I talk about not stocks, which is a funny way to think about things, but it's just how most people think. And when you get out of not stocks, there's bonds, but then there's commodities, there's real estate, private equity and private debt. There are hedge funds, which is a vehicle I'll get to. But anyway, if I remember to do it, I have linked to this blog in the email that I've sent you. And so it's just another way to kind of hear from me what I think about it. And I've been thinking similar things for a long time is one other part of this. The other thing I want to show you is I'm going to, I've gone to the CME group where you can trade futures and commodities and things like that. And I just want to give you an example, of all the different types of things that are not stocks and bonds that you can trade. This list is, I'm scrolling here and I'm not even a third of the way down the list. If I go to the filter by asset class, agricultural products, look at all the different types of agricultural things, livestock versus cryptocurrencies versus energy products, like natural gas, versus foreign exchange versus metals, in each of these metals, there's base metals, there's precious metals, all that. So livestock is a totally different investment and thing than palladium, right? And the point I'm trying to make with that is that these, commodities in and of itself is such an enormously diverse set of investment options that just lumping all commodities together is probably overkill. It's just way too big of a catch-all category. And then to take that commodities and lump it into a bucket with all this other stuff and call it all alternatives is just an unbelievable amount of things to lump into a single thing. So it's impossible for me to tell you, here's how much of alternatives you should have in your portfolio. It really depends on what we're talking about and, all these other things. Okay, so these are the things that we can invest in as alternatives. And the question is, how do we go about doing that? All right, so how do we go about doing it? What are the vehicles that allow us to do it? Well, you can either invest directly, you can go through managers, and more recently, maybe the last 15 years or so, you can use liquid funds to do this. So let me start on the right under liquid funds. Liquid funds are what I refer to as 40 Act funds. So just legally, there's an Investment Act of 1940, and that controls, I'm speaking to a lot of attorneys, so I hope I don't butcher this, but essentially that act controls the rules that go around ETFs and mutual funds, the stuff that we typically invest in that most retail investors are buying in the way that you get low cost, diversified access to a big pool of investments. Traditionally, it's done through mutual funds and ETFs that are created under the 1940 Act, or as most of us refer to it, the 40 Act. And now they've started creating these 40 Act funds that provide liquid access to these types of investments. Generally, they're the most liquid, they're the lowest cost, and they have the lowest investment minimums in terms of using these products to get access to the investments. The reason it's all in red, and I'm signaling that this is not the way to go about doing it, is that it's basically by virtue of getting liquid, low-cost access with low investment minimums to these alternative investments, it's almost by definition that they have to water down the benefits of what make alternative investments attractive in the first place. So then the next step up would be going to managers, and I'll get to this later, but you can think about this as like hedge fund managers or something like that. Managers, they're not going to wrap the investments in a traditional fund, like a 40 Act fund. So I'm not talking about mutual fund managers or ETF managers here. I'm talking about like independent hedge fund managers or entities that basically don't have to register and follow all the rules of 40 Act funds. These are going to be less liquid, they're going to be higher cost and higher investment minimums. Usually they're going to be diversified, but specialty specific. So you're not going to go to a manager that's going to be buying lean hogs and Palladium and Picasso art, or at least hopefully you shouldn't be, because no one is going to be an expert in all these diverse array of things. Using managers is better for some things than others. So if you want to buy art, if you want to buy real estate, if you want to buy collectibles, you can go do that yourself. And I think that's a good way to do it. If you want to buy 30 tons of copper, you're probably not going to go buy the warehouse to store it. And so that's a scenario where you would want to go through a manager to get that access. Finally, in green, which I prefer the most, this is, in my opinion, the best vehicle for a lot of things, is just buy it directly. You go buy the thing directly. You go buy the apartment, the office building, the work of art, the collectible, whether it's a car or a guitar or whatever it might be. You get a farm and raise some livestock. You go buy the things directly. It's going to be the least diversified, generally speaking. It's going to be the highest cost and the least liquid most of the time. And you need to be the expert. So, unless you're just like a complete Renaissance person, you could go buy a giant plot of land and build a warehouse for your copper and have some livestock and, collect classic cars. You could do all that, but you're probably not going to be an expert in all of it. Most people are not. So you need to be the expert on the thing that you are going to be investing in. Okay, now I'm taking a slight diversion here because I have this one specific friend who and he's not. This person's not a client, but he will say things like, "Well, he's a hedge fund guy," or "She's a private equity girl," and it's his way of saying that person is brilliant / rich, and what they are trying to convey is that. Let me rephrase. What they're trying to convey is that person is rich or that person is super smart. But the thing is like these terms don't really tell me much. They don't give me a lot of specific stuff. There are certainly brilliant private equity people and brilliant hedge fund people, but there's also people that destroy their careers and their finances through trying to do this stuff. And a hedge fund is not the same thing. A hedge fund is like a vehicle. It is not an investment in and of itself. And private equity is just a subset of the alternatives universe. So these aren't things the way people usually refer to them. So for definition, a hedge fund, it's just a pooled bucket of money that has more flexibility than a 40 Act fund. It can take more risk, or it doesn't have to, but it can take more risk than what a 40 Act fund would allow. And it could have one of a million different strategies. So you might have a hedge fund that focuses on commodities or focuses on shorting companies, betting against companies. Or you could have a hedge fund that goes and buys loans from banks. You could have a hedge fund that does a million different things. And so just saying that something is a hedge fund doesn't actually tell you anything about it. If an alien came to Earth and said, I want animal, it's like, well, that could be a million different things. You don't know what that is. Hedge funds is just a broad, catch-all bucket for investment strategy that is pooled money, that is basically less regulated than a traditional 40 Act fund. So trying not to go too far down the rabbit hole here, I'll just say you see all this research about why or how active managers can't beat the market over time. And I'll make a separate video maybe at some point, but just to say, I think people misunderstand why it is that traditional investment managers or funds have trouble beating the market. I think people don't realize how handcuffed they are and what they can do. They're going to have, by prospectus, they're going to have rules around how concentrated they could be. So if their universe of investment options that they need to track is the S&P 500, they can't just say, well, I think these two stocks are the best in the S&P 500 and I'm going to go buy them and have an entire regulated 40 Act mutual fund that has two holdings in it and is ultra concentrated. And they couldn't go short or bet against the other 498 companies. These 40 Act funds have significant amount of sort of regulation that is designed to protect us as the investors in the funds. And a hedge fund could do that. A hedge fund could go buy two stocks and short the other 498 and just get accredited investors that understand the risk in theory. And, they're either going to make a mint or they're going to go to zero and just have tremendously more risk. So anyway, hedge funds fall in the manager category on that previous comparison chart that I was showing you, right? There was the direct purchase vehicle, like that's you going to buy things. There was the liquid 40 Act fund vehicle. And then in the middle, there were managers. And hedge fund managers would fall into that category. And when somebody describes something to you as hedge fund, that doesn't really tell you anything. And if somebody's trying to sell you something and they just keep throwing out words like hedge fund and private equity, and they can't give you any very specific details on what they're actually talking about, it just tells you that they don't know what they're talking about. You should be wary. Private equity funds buy ownership in companies. So if you start a company or you invest in a non-public company, you're theoretically in private equity also. So public equity is just stocks. You just you go to the stock exchange and you buy the stocks. That's public equity. Private equity is just buying a company. So if your friend starts a business, if somebody comes to you and they're raising money to start a business, that's private equity. Now, obviously, it can become much more sophisticated than that, and there are entire firms that go around and buy up companies. Maybe they focus on the healthcare sector, and you'll have a firm that goes around the country and buys up healthcare-related businesses with the intention of improving them, and 5 years down the road, turning around and selling them again. That's private equity. But it's just... I think my industry often makes things sound more complex than they really are, and all private equity is buying ownership in a company that is not a publicly traded stock. That's all it is. All right. So what makes alternatives special? Like why, if I sound negative about them, why would I ever advise somebody to buy them? Well, traditionally, they are diversification tools. So academic theory tells us that any investment that is not 100% correlated with the rest of your portfolio will be a net benefit to your portfolio in terms of risk and reward. The more non-correlated stuff that you're invested in, the broader your diversification is, and the overall better ride you're going to have over time in terms of like a smooth ride, more stable investment returns, and the risk-reward trade-off continues to improve. That doesn't mean that your absolute return improves. a hyper concentrated portfolio of one stock could return 100%, and a diluted diversified portfolio of 500 stocks might return 7%. But that 100% return, could also go to zero very, very easily. And it's going to be a much more volatile ride. The portfolio of 500 stocks most likely is not all 500 are most likely not going to go to zero. And they're all moving around in different ways at different times. And so the volatility, the up and down movement is going to be a lot lower. You have the potential for outsized returns. There's a couple of reasons for that. And at least on the face of it, you can be shown statistics that tell you that alternatives have lower volatility. Okay? But beware. In terms of diversification, I'm going to give you two examples. Think about two buildings that are next door to each other on a city block. One of them is publicly traded, part of a real estate investment trust, which I won't get into, but real estate investment trust can be shortened to be REIT, R-E-I-T, REIT. So you might have a publicly traded piece of real estate through a REIT, and then literally next door to it, the exact same building, but it's privately traded. Does it make any logical sense that if the publicly traded building has been shown to decline in price because it's publicly traded, and so it's valued constantly by investors, does it make any sense that the building next door, that's the exact same building, would not have declined in price just because we haven't valued it? It doesn't make any sense. So just beware that, yeah, in theory, these things can offer diversification, but many private things are more similar to the public things than you might believe when you're looking at statistics that someone would show you. Think about two beverage companies. So if you want to go invest in a beverage company and it's a privately held company and all you've seen are massive increases in value for the beverage company over the history of its existence, and you compare it to the food and beverage industry, and the food and beverage industry of publicly traded stocks over the last 5 years has declined by half, do you really trust the numbers you're seeing from the private company? Does it stand to reason that that beverage company is that much better than the broader industry? That they have somehow, found the magic? I don't know. So just be aware of that. Potential for outsized returns. Public stocks also have this opportunity, but you have to think about the risk. So if you go buy or invest in a private company, you're most likely just investing in one private company or two private companies, because the investment minimums, like traditionally, if someone's starting a company and they're going to raise money to start the company, it might be a minimum purchase amount of $50,000 to even buy any portion of the company at all. Or it could be $100,000, or it could be $1 million. So you're probably not going to buy 500 private companies like you are if you just go buy the S&P 500 index. So yes, you have the potential for outsized returns in any individual company that you're investing in, but that's true for public stocks too. Like if you just bought one single stock, you also have the potential for outsized returns. But in both cases, this comes with extreme risk. You're just concentrated. You're not diversifying your holdings. You're putting all your eggs in one basket. So be aware of that. To be fair, in the potential for outsized returns category, if you're investing in a private company, you're probably an earlier investor in the company. So usually companies don't go public and issue stock until they've already been around for a long time and have demonstrated to the markets that they are a viable company that will probably be an ongoing concern, has significant size such that there's even a market for their stock in the first place. And so if a company's private, there's a good chance that you're an early investor in that company as compared to, I always use like Ford Motor Company when I'm doing these videos. I don't know why, but, public stocks usually have been around a lot longer. So if you're in the private company, then you may be an earlier investor. That truly can give you a potential for an outsized return. And then the private markets are probably worse at pricing. So if you wanted to go buy Coca-Cola stock, then you have to believe that the most educated, sophisticated stock analysts in the world are accurately determining the price or the fair value of that stock at any given time. You can kind of assume you have the smartest people in the world valuing these companies, and therefore the pricing of those companies, the valuing of those companies is probably pretty efficient. Private markets, it's like Wild West, pirates. Like you don't know. One person or entity might value a private beverage company radically differently than another person could. And so because there's such a wide disparity in the valuations and pricing of private companies, then there's a lot more room for you to pick up, a bargain or a deal, or turn around and sell it to somebody that doesn't really know what they're doing. So private markets can be worse at pricing, and that can deliver the potential for outsized returns. And I keep focusing on like companies, like buying portions of companies or real estate. And again, alternatives could be art, they could be collectibles, they could be, a million different things. So it could be farmland or soybeans. It could just be a million different things. But generally speaking, these things are true. Lower volatility. All right. Well, why do private markets have lower volatility? Well, it's because we have our head in the sand when we're valuing them compared to the public stuff. So if you think about publicly traded stocks, there are millions of shares of Coca-Cola, or really, many, many, many publicly traded companies trading every second of every day that the stock markets are open. And thousands of investors are getting together and buying and selling and determining the fair price at that particular moment. Whereas an office building might not get sold except once every 25 years. So how do you value that? Picasso might not get sold once every 50 years. Collectibles, like all these different things, private companies, they may do a valuation if they have to once a year. I don't know, maybe some of them do it once a quarter, but I doubt it. They're just priced, and a market price is determined far more infrequently for private investments than for public investments. And so essentially you're just sticking your head in the sand and saying, I don't care. Now, to give the benefit here, that's probably a good thing. Over time, that is probably a good thing. If investors didn't see the gyrations of the stock market every single second, every morning when they turned on the news or whatever, if they didn't see that, everybody would probably do far better in terms of investing because they wouldn't buy or sell emotionally. I think that brings me to another thing I wanted to show. Hopefully I didn't get rid of it. Okay, here's what I wanted to show you. I've plugged in, you can't see it because it's off screen. I'm only sharing a portion of my screen for the presentation. I plugged in the iShares S&P 500 ETF, IVV, like Indigo, Victor. That's the fund that I traditionally use for clients when managing money and they need the S&P 500. Over the last year, it is down 4%. I bet if I asked 90% of investors out there, non-professional investors, how is the S&P 500, a proxy for the U.S. stock market, how has it performed over the last year? Most people would say it's done a lot worse than that. And the reason is because everybody's had to go through these gyrations in the stock market and hear about them constantly, all day, every day. And it feels a lot worse than it actually is. And so just imagine you went to bed a year ago and you woke up and you found out that over the last year, the market's down a grand total of 3.94%. You would probably feel different about that. You may not even blink as compared to having experienced all of this. When we look at the drawdowns, the drawdowns have been pretty massive. Back in October low, we were down 16.7% from where we were a year ago, May of 2022. So that's what I'm referring to when I'm talking about the private markets have their head in the sand. Private markets don't have to sit there and feel this every single day. These investments don't get valued very often, and therefore they have a much, much smoother, at least perceived smoother ride than publicly traded things do. All right, so we're 30 minutes in, and now I'm going to get to the point about so how much do I invest in alternatives? Well, the most annoying thing I can say, it depends, as does everything else that we do in financial planning and investing. So the way I'm going to think about it, or I'm going to ask you to think about it, is different size investment portfolios. Is it a $42 billion portfolio of money that's been saved that's only spending $1 billion a year? Is it a $2 to $10 million portfolio where the person's spending $500,000 a year? Is it a $200,000 portfolio where the person's spending $200,000 a year? It matters. So what is the $42 billion portfolio? Well, that's the Yale endowment that I'm using as an example here. It has a low liquidity need. They have $42 billion and they're spending 1/42 of that per year. So it's a low liquidity need. It's an endowment for a university, so it has an indefinite time horizon. There's no, they obviously they have liquidity needs every year, but they have budgeted for that. There is a large chunk of their investment portfolio that is not needed, and for the foreseeable future, literally probably hundreds of years, may not be needed. So they can go 95% alternative investments. Yale Endowment could go buy thousands of acres of farmland. They could buy timber forests in the Pacific Northwest. They could go buy art. They could do all sorts of crazy things because their time horizon is huge. Their liquidity need is extremely low. And I'm just going to take another kind of diversion here and tell you, if you want to go look at it, I would suggest you do. Just go to just Google Yale Endowment and read about it. There is, if you scroll down here, you'll see how they talk about the endowment allocation. They talk about how they have funds earmarked. And then there's the investment strategy, and they link to the investment strategy. And when you open that, it's going to take you here. If you scroll down, you'll get to the investment philosophy, and it's going to have this picture of David Swinson, who is considered the godfather of alternative investment strategy, particularly for endowments. Many Ivy League and other university endowments have tried to replicate what he did. He was among the first to start introducing major allocations to alternative investments over time, and it worked well for Yale, and that's what they'll talk about here. I'd encourage you to look at this if you have any interest at all. And then you can scroll down and see the asset allocation and look at these percentages. So on the right-hand side of the chart, we get to modern times, 2020, and let's see, they've got cash and fixed income, some domestic stocks. Look at their domestic stocks here in blue. Hopefully you're seeing this and not just listening, but domestic stocks are less than 5% of the portfolio. They have some foreign stocks, but on total, it looks like they've got about 25% of their investments in things that are not just regular stocks and bonds. They've got leveraged buyouts, venture capital, natural resources, real estate, absolute return. So they are able to allocate a significant amount of their portfolio to things that are not just long-only stocks and bonds because they have low liquidity need and indefinite time horizon. So, I'm being a little bit facetious here. They were probably more like 75% alternatives, but I said 95% alternatives in my example, but you get the point. It's based on liquidity needs and time horizon here. Okay, so now what if you are a high net worth person? Most of the people watching this video, I think either you're already here, you're in the $2 to $10 million range, or the vast majority of you, you're not there yet, but you are well on your way. And so this is realistically where I think this and the next one over are what I think are most relevant to you that are watching this. So you have a moderate liquidity need. Obviously even 2 to 10 million is a ridiculously large span of investments, right? But let's just say you're at 2 million and you're spending 500,000 a year. You have a pretty high liquidity need. You can't take a lot of that money and put it in stuff that you can't access or touch for the next 10 years. If you have $10 million and you're spending 500,000 a year, then you've got a lot more room. So I'm just saying, I'm trying to do my best here to kind of categorize things. I'm just saying you've got a moderate liquidity need, but you also have meaningful portion of your assets that are needed for your lifetime, whether it's retirement or other goals. You've got a significant portion of this portfolio that you can't risk complete loss or locking it up for decades. And so an extraordinarily rough generalization would say, somebody in this range might max out at 25% of their investment portfolio in alternatives, while 75% is considered liquid. And of course, you may be thinking liquid. I thought stocks aren't particularly liquid because you might get forced to sell them at the wrong time. Like you didn't want to have to sell back in October of 2022 when the markets were down 25%. That's true, but relative to alternatives where you can't just turn around and sell an office building, the next day, stocks are more liquid than that. And if you had to, you could engage in a fire sale and get rid of the stocks. So in the context of alternatives, publicly traded stocks and bonds are liquid. The alternatives bucket, where things are done in private deals and not on public exchanges, those are like truly illiquid. And so you have to really, really be wary of how much of your investment portfolio you can afford to lock up like that. And I would say for this, household net worth range, that 25% is probably the max. Realistically, if you're at $2 million, you're probably talking about more like 10%. Okay, and then finally, the accumulators. So you've got $200,000 saved up. You're spending $200,000 a year. You're just in the accumulation phase. You have a very high liquidity need. I think I'm being generous by saying you could allocate 5% to alternatives, and the rest of your portfolio, 95% of it needs to be liquid. I started to write 0 alternatives here, but for 2 reasons I didn't. One, I don't want to seem biased against them because I don't charge fees on alternatives. Obviously I could have you invest in the liquid funds like mutual funds and ETFs, but that is not what I think you should do, so I don't do it. But I myself am invested in 2 companies privately, and I'm not in the $2 to $10 million range, so I fall into this category where most of the rest of you do, and I have 2 private investments. So, and I have all these guitars that many of you see in the background of my Zoom, and so I can't with a straight face say that you need to have 0 because I actually have a little myself. So that's sort of the way that I think about it. How much should you allocate? Well, it depends on your liquidity needs and your time horizon. Depends on what your expertise is and the types of vehicles that you're going to use to get access. It depends on a whole lot of things, but this is sort of my, trying to give you an answer, generalized breakdown of it. All right, so you heard all that. So here's what you need to be aware of. First, there is a massive proliferation right now of liquid alternatives to sell to retail investors. This is a relatively new thing that asset managers can offer and sell. It's a new revenue line for asset managers. So that's something I wanted to bring up and show you and just give you a sense of, here's the Dave Swinson Wikipedia. I would go check it out if you want. I also forgot to show you this. Blackstone has a REIT known as BREIT. And just as an example for liquidity purposes, I know this is not what I was just talking about when I flipped over to this page, but just go Google Blackstone REIT or BREIT GATE, G-A-T-E. And it's an example of a private investment that does private real estate. Blackstone is one of the largest private investment or alternative investment funds managers in the world. I think they are the largest in the world. And they've been limiting investor redemptions out of their private real estate fund, BREIT, for the last, I think it's 6 months now. So this article was from April 3rd, so it just talks about blocking withdrawals up to that point, but it has since blocked withdrawals again. And so they're getting huge requests for redemptions to get out of their fund, and they have a preset liquidity limit of 5% of the fund at any given month to withdraw. I think it's every month, maybe it's quarters, but I think it's every month that you can withdraw from it. Because it's a private fund, it's not a traditional 40 Act ETF or mutual fund. They can set a limit saying, look, we'll honor redemptions up to 5% of the value of the fund, but after that, we may block them. And so now they're at 6 months worth of blocking redemptions because, like in this example, they had honored redemptions of $666 million, which was only 15% of the $4.5 billion that was requested to be redeemed for the month. So it's amusing to me because a Blackstone spokesperson said BREIT is not a mutual fund and has never gated. They're saying that this is not a gate. It's a semi-liquid product and working exactly as planned. And part of me says, yeah, that's true. It is true that it's working exactly as planned. It is a semi-liquid product. They explicitly tell you that they're only going to allow you investors to redeem a certain percentage. But my point to bringing this to your attention is, what if you're the investor in this? You have a $200,000 portfolio and you've put $50,000 into the BREIT product because you believe that real estate is, the investment of the future or whatever. And all of a sudden you find out you're unable to get your money out. It's just, you would feel like that is a gate. Even if I had told you until I was blue in the face that they could limit your withdrawals, I think you would be unhappy with this sort of thing. And it's just an example of how liquidity can work in these types of alternative investments. And you just need to be aware of it. Okay. Anyway, so back to what I was going to talk about, where you can get these funds. All right. Had to recreate the wheel real fast because my session had expired. So what I'm showing you here are 4 different investment funds to talk about. Let me bring your attention back to where we were because I got on a tangent. I'm talking about the proliferation of liquid alternatives to sell to retail investors. It is a new revenue line for asset managers. So many of you are well enough informed to know that you should not pay a lot for investment funds. So like IVV, the S&P 500 ETF I use, charges a net annual fee of 0.03%. So it's a very, very low fee product. Well, if you are an asset manager and your entire business is selling investment products to investors, that's not going to generate a ton of revenue for you unless you have unbelievably high volumes of sales, right? So what can you do? Well, you can start charging more for sort of alternative, esoteric, new, unique strategies, right? So I used to work for Wisdom Tree for 8 years. I sold the Put Right strategy fund, which takes the S&P 500 and writes options against it to reduce volatility. And the other side of that is that it caps upside returns. I used to work for Principal Financial Group prior to Wisdom Tree. So I was at Wisdom Tree for 8 years, and I was at Principal Funds for 6 years. And then I started this company. Those are my 2 companies I've worked for. The Diversified Real Asset Fund. This owns real assets, so a completely different strategy than the Put Right Fund, but still within the alternatives bucket. And then Invesco. I've not worked for Invesco, but I'm familiar with this fund, and Invesco used to have a big operation in Houston. This is a commodity strategy, and all of these are liquid alternatives. They're underneath the 40 Act fund umbrella that I was talking about earlier. And so these are examples of ways to get liquid exposure to alternative investments, whether it's options in the case of Put Right, or real assets like real estate and things like that in the case of the Diversified Real Asset Fund, or the Invesco Commodities Fund. The thing I'm trying to show you here is not the performance over here. You can't even see it. It gets off the screen. But what I'm trying to show you are the fees. The S&P 500 costs 3 basis points, 0.03% per year. Put Right is 44 basis points. The Principal Fund is 84 basis points, and the Invesco Commodity Fund is 59 basis points. These are new lines of better margins, revenue-generating products, and you need to understand that and be aware of it. My inbox is filled with asset managers telling me to look at their alternative investment strategies because alternatives are an important diversifier in client portfolios, and we should all be using them. And, oh, by the way, they have a liquid version of them that we can use inside an ETF or a mutual fund wrapper. Well, the other thing that's going unspoken is they are huge margin products for those companies, huge revenue generators, and they can't come to me and tell me they can't convince me to switch out of my S&P 500 ETF that has a very long established track record from the largest asset manager in the world and costs 3 basis points a year. They have to come with something new. And they're going to do that to you too, and you'll see it in commercials and all sorts of stuff. And then just for the record, over the last year, what did you get for those diversification tools? You got lower performance than the S&P 500 from every single one of them. I haven't looked at the volatility, but yeah, similar volatility. So it's just something you've got to be aware of, and just understand that there is a big proliferation of these types of products for people because there is a need to come up with new stuff to sell us. It's critical to diversify, right? So you don't want to just say, I'm going to be a real estate investor and go buy a single property. It's like buying a single stock or buy a single piece of artwork. It's really important that you get enough money together to diversify your holdings of alternative stuff, because otherwise you're just putting your eggs in one basket. When we go buy the S&P 500 ETF, we're buying ownership in 500 companies. And, if I'm managing your money and we're globally diversified, I think the last time I counted, we were on the order of 9 or 10,000 individual securities that you're investing in across stocks and bonds. You need to be able to diversify, and that's why it takes a lot of money. If the minimum investment for a private equity ownership is $50,000, you need $250,000 just to diversify across private companies. You want to go buy $1 million piece of art, you need $1 million. And you want to go buy multiple of them and diversify, you need a lot more than that. Nobody is an expert in all of it, so be very, very wary of people that claim to be alternatives experts. Like, one of my alphabet soup designations after my name is the CAIA, the CAIA. That's Chartered Alternative Investment Analyst. You can find people like me online that will claim that they are an expert across the enormous universe of alternative investments because they have the CAIA, and trust me, they are not. Everybody is confident in their idea. So when your brother-in-law comes to pitch you their new company startup idea, of course they're super confident in it, and of course they have cornered the market on whatever it is they're going to do, and they have the expertise. And some of these things are going to work out. I know I sound irreverent. I am pro-alternatives. But just understand, no one's going to come to you and say, well, I think it might work. Give me $50,000 to help start this company. It could go to zero next year. I don't know. I mean, no one's going to come to you and say that. So just, beware of that. The fees are high one way or another. So either you're going to pay the fees explicitly, like I showed you on that previous screen, through liquid investments, or you're going to pay a manager to manage it for you, and maybe they're going to charge you 2% a year for the privilege, and then they're going to keep 20% of the profits that they make. So just understand that the fees are high. Or even if you go buy direct, you're probably going to take real estate for an example. You're probably going to pay real estate commissions and closing costs. Or if you go buy art, you're probably going to have to go through a broker, most likely. Or just the things are just expensive in general, right? So the fees are going to be high, generally speaking, as compared to traditional stocks and bonds. People are susceptible in volatile markets. So when markets are really volatile, when the S&P 500 was down 25% peak to trough at one point last year, people were scared and they're looking for other ideas and, no pun intended, alternatives to the traditional stocks and bonds. And that is when the peddlers of this stuff are going to strike while the iron is hot. So just understand and beware that people are susceptible to too good to be true ideas like this in volatile markets. All right, so this is the last slide. In conclusion, I like alternatives when the tool makes sense. So it needs to make sense for your portfolio. There needs to be a rationale behind it that is based on you and not on the person trying to sell you the idea. I'm biased because I don't earn AUM fees on stuff that I don't manage. So it's important that I acknowledge and say that. If you take all of your money out of stocks and bonds that I manage and I'm charging you an asset management fee, I'm biased. I like to think that I'm not, but if you take all your money away, you're just down to my minimum annual fee for financial planning every year, right? So I have to say that, I have to say that I am biased. Again, I own 2 of these myself, and I do have clients where I've advised them to go do this stuff, but I'm biased. I'm invested in 2 private companies myself. I'm a private equity guy, related to that previous slide. So I put my money where my mouth is. I do like alternatives. You just have to be very careful about what it is you're doing and the why. And everything has risks and benefits. If it's too good to be true, it probably is. So if somebody comes to you and says they've got this alternative investment idea that is going to return 10 times your investment for half the volatility, that is BS, and do not believe it. They may get lucky. You may get lucky. I hope you do. It'd be great. But there is no free lunch. The market is filled with enough participants that they could arbitrage that stuff immediately if they needed to or wanted to. And finally, again, I like alternatives. I'm not trying to get you to shy away from them, but I'm just trying to explain when they make sense for you, how I would think about allocating to them. And for the vast majority of my clients, we're just not in a position yet to allocate enough money to these that can be locked up for an extended period of time for it to really make sense. But I think we're all headed that way, and it'll become a bigger part of your portfolio over time. All right. Thanks a lot. Have a good weekend. Bye.